Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Juice. Last Tuesday, I saw a financial media headline that made me think twice. Hilton missed revenue estimates for its quarter and guided revenue and profits down for the full year. So, the stock tanked after the company reported earnings before Tuesday's open. And of course, other travel stocks, including Expedia and Airbnb, dropped meaningfully on the news. One stock in a sector reports bad news, it tanks and takes related names down with it. This happens all the time. Some of the time, it creates opportunities for investors. So here's what the market missed. When the Hilton news hit, I thought, why is Airbnb dropping as well? Technically speaking, the two companies run in the same space. However, they don't look alike at all. Both companies have fundamentally different business models. The market missed this modern-day reality when it punished Airbnb for Hilton's setback. It also failed to realize that Airbnb was about to report earnings Tuesday after the bell. And Airbnb crushed it. Again. Airbnb grew revenue by 70% year over year and 80% compared to 2019. The company's net loss decreased significantly. For the first time ever, the number of nights and experiences consumers booked with Airbnb eclipsed 100 million, hitting 102.1 million, a 59% year-over-year increase. This number is 26% higher than the same period in 2019. Looking ahead, Airbnb expects Q2 2022 revenue to fall between $2.03 and $2.13 billion. Ahead of the $1.97 billion consensus estimate. For the record, prior to Tuesday, Airbnb had beaten EPS estimates 75% of the time and revenue projections 100% of the time over the last year. Interestingly, Airbnb is emerging as a really useful indicator for the travel sector. So, getting down to brass tacks, should you buy Hilton on Airbnb's news? Probably not. Should you sell Airbnb because of what's happening at Hilton? Obviously not. The bottom line is this. We live in a new world. While investing has evolved, old habits still persist. One of the most glaring is sector risk, where investors take down shares of a company because of what happens to another, simply because they operate in the same broad space. While they're all technically lodging companies, that's where the comparisons between Hilton, other legacy travel companies, and modern-day disruptors such as Airbnb ought to end. If you were paying attention when Hilton dropped a bad report, you could have scooped up shares of Airbnb before it reported impressive earnings. Even with Airbnb's post-earnings pop, be on the lookout for a dip and any further weakness. If you're a long-term investor looking to take advantage of travel creeping back to pre-pandemic levels, Airbnb might be a nice place to start. That's all we have time for today on The Juice. Click follow and subscribe to The Juice email for your daily dose of market minerals.